Everyone wants to know when the stock market will crash. That's a difficult thing to predict, but we do have many statistics to provide us with clues. The central bank ultimately decides when it will happen. If they provide ample liquidity, the market continues to ascend. If the central bank dries up the liquidity, in comes the crash, bang, and boom. You came here for the truth, so let me unveil that for you. Today we're going to get into one very important topic: when. So I'm going to cover that today. I'm going to show you so much more. So stay tuned for this jam-packed episode. Fed and the 10-year interest rates versus real economic growth. I want you to turn your attention to the chart on the left-hand side. I've been wanting to know this information, and I'm really glad that Real Investment Advice has provided this. They've went along and tracked all of the data. Quarter of the first rate hike, and then the quarters to recession. So essentially, how long does it take from their first rate hike up until the point where there is a recession? You can see that the Federal Reserve had increased interest rates at the end of 2015. And so here we are today, barely, I stress that tone, barely up to the levels that historically are deemed to be unbelievably low. And that's where we are today, right here. Going back in time, you will see, for example, leading up to the financial crisis. In 2004, they started to increase these Fed funds rate, the interest rates, and it took 14 months to get officially into a recession. Now you can see the rest of these, and I would say that on average, it's about 1 year. Now, clearly, we've gone far, far beyond that. So is this an accurate indicator? Well, as you can see in this case here, this one tends to stand out. 1963, quarters to recession, just over 2 years. One of the important things we need to understand is that it is the central bank that decides whether there will be liquidity or not. They also tie in the GDP growth rate into these charts, showing us that we have these issues tied into basically the fact that it should have been a time in which the market should have crashed right away because the growth isn't there. But here we are today. And that brings me to my next point. When you look at the Fed funds rate, you can see what I showed you before. The first time they raised interest rates up until where it is today, historically, is incredibly low. Even if you were to take off this point right here during 1980, because that in itself is an anomaly. So even if we were to just cap that off at 12.5%, where it has been once, and also nearly there back in the mid 80s here, looking at that, we can still see that today is historically unusual to be this low. But 100% of the time, when they increase interest rates, it results in a crash. You could see the gray area, the shaded area, is a recession. They increased rates. In this case here, recession. Increased rates, recession. But what I've noted is that as time goes on, they cannot get the rates up to where they were previously. And it is my estimation that we wouldn't even be able to get to the level of 5% on the Fed funds rate. It will not be able to hit that high. And I would have to guess that it would have been around the 3%, maybe a little bit higher if they are, very generous. So I'm going to say Fed funds rate at 3% is probably the top. So if you want to know when the next recession will be, or the next stock market crash, my best guess is Fed funds rate at 3%. So I don't normally make predictions, but ultimately it is the Federal Reserve deciding the liquidity scenario, and a very intelligent individual who, I won't say too much, but an individual who, deals with trading was really breaking it all down for me and explained this scenario and how ultimately these central banks have their fingers on the trigger and they can literally pull it at any moment. So this is something that's going to be common knowledge for some, but for the average person, they simply do not understand this. And, a lot of people in the financial industry don't understand this either, and that is quite sad. But we're talking about open market operations. I cover this in my books, and within the open market operations, by the way, if you want to know more in detail about this, I have a free video in my free e-course, I should say. So if you go to the free e-course, you'll see this open market operations, all right? Open market operations, the purchase and sale of securities in the open market by a central bank, are a key tool used by the Fed in the implementation of monetary policy. What is monetary policy? Printing money. The short-term objective for open market operations is specified by the FOMC. Before the global financial crisis, the Fed used OMOs to adjust the supply of reserve balances so as to keep the federal funds rate, the interest at which the depository institutions lend reserve balances to other depository institutions overnight, around the target established by the FOMC. Let me say this in English, okay? This entire big paragraph of jargon. The Federal Reserve prints money to manipulate interest rates. Okay? Very simple. That is not absolutely not a theory. That is not something that I have created. This is a fact, and I am pulling this information from federalreserve.gov. If you want to see it for yourself, you can do that. Now, think for a second. The Fed has stated that they are going to be, if this is their balance sheet, where it has gone, then it trailed sideways, and now they're suggesting they're going to start to wean off. Okay? If this starts to trickle downward, what do you think is going to happen to interest rates as a result? If they're not engaging in these open market operations, they're not printing money to make sure that these interest rates stay low. What do you think the stock market is going to look like? I assure you, it's going to be the exact same thing. The exact same thing. Just as the markets have come up, all in line, completely coordinated with the different central banks around the world, whether we're looking at G3, G4, and so on, all of these central banks have been printing money. All of them have a massive balance sheets. We're looking at $15+ trillion just since the financial crisis. And so if they pull back on that, if they dry up liquidity, you will have a crash. I'm not predicting that. That's what the Federal Reserve's website has suggested. If you look at their own sites, I'm using their own websites to determine this. It doesn't take a genius. Let me go back to this. Let me just do this. I wasn't going to do this, but every time, so you could see recession, these are all recessions, right? Don't go anywhere. Make sure you watch part 2 of this video. I'm going to get into so much important information. I'll see you there.